Prosperity is more than a number. It's the power to shape what's possible for you, your family, and your heirs. Here, you'll find ideas for building wealth, safeguarding it, and translating it into true prosperity with insight from actual business owners and financial professionals. Welcome to the FDP Prosperity Report, hosted by your Chief Prosperity Officer, Mark Chandick.
I'm Mark Chandick, and welcome to this edition of the Prosperity Podcast. I'm excited to introduce you to Michael Harden. He's a CPA and a CFA. He's also Senior Managing Director of Ambrose Advisors in Irvine, California. He has nearly 30 years of experience in accounting, mergers and acquisitions, financings, ESOP buyouts, and valuations. He's a specialist in ESOP buyouts and therefore has experience in a wide array of industries, including craft breweries, energy, technology, government contracting, manufacturing, distribution, and business services and construction. Mike graduated from the University of California at Santa Barbara with a BA in Business Economics and Accounting with honors at summa cum laude. So let's just jump right into it. It's a very timely subject that everyone is talking about today. Mike, why don't you explain the process of selling a company to an ESOP?
Thank you, Mark. Thanks for having me today. I really appreciate it. When a business owner gets to the point where they want to take their life's work and achieve liquidity for it, typically we're dealing with privately held businesses and most of the wealth is tied up in the company. And so what we really do is help them unlock that value and convert it to cash over time. Sale of the business, in summary. You can, in a traditional way, go out and find a buyer for the business via, some kind of a competitive auction type process where you would identify strategic and possibly financial buyers to sell the company to, and that's a pretty straightforward transaction that everyone's accustomed to. To us, the ESOP is just another buyer of the business. So we use the ESOP, which stands for an Employee Stock Ownership Plan, as a buyout tool, as a way to help that business owner unlock that value in a way that that stock is put in trust and transferred to their employees over time at no cost in lieu of nothing. So really, it gets the owner a buyout in a way that doesn't happen quickly. An outside sale, as an example, they're probably out within a year or less. Sometimes private equity might want them to stay on longer, but generally a sale of the company, they're out relatively quickly. An ESOP is what we call a staged exit. The owner's going to sell, they're going to get part of their value in cash down, and they're going to take back notes for the rest, and those notes are going to get paid out over time. But it does, in earnest, depending on the company and the strength of its cash flow, take 5 to 7 years typically, broadly 5 to 10 years, but most of them 5 to 7 years for that owner to be completely paid out. Now, while they're waiting to get paid out, they're in full, complete control of their company operationally, and they're able to get a nice return on the notes that they take back too. A combination of paying them interest and maybe even giving them some form of equity like stock options, stock warrants that they would retain in the company for some period of time.
Okay, that's a great explanation. Thank you for that. How does this process of an ESOP differ from, let's say, a sale to a third party that you just mentioned?
Well, the process we go through is almost identical because we still have a buyer with an ESOP. It's the trust itself, and that buyer has to be represented. So we bring in independent, expert ESOP trustees to represent the ESOP in the transaction because all the employees are part of the ESOP, but they don't have a seat at the negotiation table. So they need a representative who's qualified to do proper due diligence on the company, set the value, and negotiate the price and terms. We always represent the selling shareholders. So there's two sides to an ESOP, a buy side and a sell side, just like there is with any third-party sale transaction. What's different is in a sale transaction, we are going out into the marketplace and shopping the company to identify a buyer, find a good fit, choose a buyer, and then we're off doing diligence and negotiations and hopefully a funding and a closing. With the ESOP, we create our own buyer. The company adopts this trust. It's a qualified plan, so just like a 401k or a pension plan, but it's unique in that it's a type of qualified plan that's allowed to borrow money to buy stock. It's the only qualified plan that can do that. So it can become a very powerful buyout tool. So that's, I think, one key difference. The other key difference is when we're out representing a company in a traditional sense in a third-party sale, we go out and we solicit offers, and so our client, the seller, is in a reactive position. When the offers come in, we've got to react to them. In the ESOP, we turn that on its head. We make the offer from the sell side, and the trustee of the ESOP is in a reactive position. Aside from those things and one other, which is, when you're selling the company to a third party, they bring all the money. In an ESOP, we have to create financing, bring that into the company so that we can provide some cash down to the sellers. So as part of putting the deal together, we not only have to have a process where we have to get the trustee through due diligence and negotiate price and terms for the sale of the stock, but we also have to place typically bank financing into the company to facilitate a down payment at closing. So aside from those three differences, the process is identical in terms of diligence and negotiations.
Okay. There are different types of ESOP transactions. Can you sell, for example, just a part of the company? Can you sell? Are you required to sell the whole company up front? What are the different options available?
Yeah, sure. I mean, we get sell as little as a share, 1% or less, or you could sell 100%. So really, it's highly customizable to sell part or to sell all. Where the analysis comes in here is that there are much different company tax incentives whether you sell part or you sell all. As an example, most ESOP companies, even if they sell part now, they're on a continuum to get to a point where 100% of the stock is held by the ESOP trust. The reason for that is once all the stock is held by the trust becomes the sole shareholder of the company stock. Doesn't matter how many employee owners we have in the trust, they're just the beneficiaries or the participants. They're not the legal owners of the stock. So if we get to that point and the company becomes an S corporation, an S corporation is not a taxable entity, it's going to give its K-1 or its tax attributes to its owners. In this case, the sole shareholder would be the trust gets the K-1, and the trust is an exempt taxpayer, meaning poof, there's no more federal or state income taxes applied to that earnings stream, which means there's a lot more cash flow available to affect the buyout on an accelerated basis. Now in California, under that structure, we would still have to pay 1.5% to the state of California, but there'd be zero federal taxes and no other state taxes. And in any other state but California, it's zero.
Wow, that's impressive. I can see why people are so excited about ESOPs. You talked about some of the tax benefits of ESOP. Are there any other benefits they derive from a tax perspective?
Yeah, and then let me complete that too. What I just described to you is kind of what we call the holy grail of ESOPs, to get to a point where you have a tax-exempt company on all the income. If you sell part, the short answer is you only have part of the tax benefits, right? Example, if you sold part and you were an S Corp, let's say you sold 30%, then 30% would go to get K-1 to the ESOP, and that would be exempt from tax. The other 70% of the income, though, would get K-1 to non-ESOP shareholders that are taxpayers. And so you really only get part of the benefits there. And if you're a C Corp, the rule of thumb there is whatever the ESOP pays for the stock becomes a full tax deduction, principal and interest, to the C Corp to lower C Corp taxable income. But that's an expiring benefit at the corporate level where eventually will run out and the company will be fully taxable at C Corp rates again. So on the corporate side, it's going to dramatically vary depending on whether we sell 100% or we sell part, and whether we do it as an S Corp or a C Corp. Probably a bigger discussion for a different day. The other side of that, though, is the personal side. And this really doesn't matter whether you sell part or you sell all. If we sell more than 30% to the ESOP in the first transaction, we can design the transaction in a way that the sellers essentially can avoid the payment of the capital gains tax. It's done through a long-term deferral structure that's meant to go into their estate, and when that gets unwound through the estate, it ends up becoming a permanent deferral of the capital gains taxes. Now, we have to do several things to structure the deal to qualify them and make sure that that can work. But in high-tax states like California, New York, and Massachusetts, and some of these other really high-tax states, we're, as an example, in California, you're looking at 1/3 is the federal and state capital gains combined rate on an S Corp shareholder is 37.1% on a C Corp shareholder. That can be 0, and that can be very meaningful. That becomes less appealing if you're in zero tax states like Florida, Wyoming, or Texas, or Tennessee, or Nevada. There, you're just looking at avoiding the 20%, and it may or may not pencil out. So we do a lot of modeling on a shareholder basis to see if that deferral makes sense. And if it does, we can structure the transaction in a way that they can essentially permanently defer the capital gains taxes, as long as they sell 30% or more in the first transaction.
I can see where if you had a sole owner, this is an amazing way to exit the company on a tax-favored basis. What about if you have, let's say, a family-owned business where you might have 1 or 2 family members that want to stay on, and let's say the founder of the company wants to exit? Does it make sense, for example, for those children to own 50% outright and just sell 50% to the ESOP? Do you see that kind of a transaction for those reasons, or does that not make sense?
Yes, in short, the ESOP can be a very good buyer of a departing partner. So in your example, the founder wants to move on, the kids want to stay on. We can put an ESOP into the shoes of the departing shareholder, and that's just one shareholder alongside, in your example, maybe 2 kids. You have 3 shareholders. So we could certainly put a deal like that together. However, I would encourage that client to run that scenario. By the way, rule of thumb for us, and this isn't necessarily in the regs anywhere, but empirically we advise clients to sell slightly less than 50 if they're not going to sell 100. We don't do ESOPs between 50.1 and 99.9. We think that's a bad transaction. So what we would typically do is have them do sales if they want to defer the capital gains tax on the sale and possibly permanently. We would start at 30%. We might do other sales up to 49.9, but then when they're ready to go, we would then move to 100. And there's a valuation reason for that that's probably beyond the scope of today.
So it's not a control reason to leave most of the control or the controlling interest with family members versus the ESOP. That is not a consideration, a primary one?
It is a secondary consideration because the fact of the matter is, even in our 100% sales, the selling shareholders are still going to operationally control the business until they're paid off. The reason for that is they're going to become the largest creditor of the company, and as part of their investor rights agreement, by agreeing to take back junior notes, they're going to have board control for some time period until they're paid off. So there really are no control issues. The people who sold are still going to run and manage the business until they've got all their cash out of it, bottom line. There's a lot of belts and suspenders and ways that we structure it to accomplish that, but ultimately it's done through board control. So control is always a question, but I can tell you it's never an issue. If we sell less than 50%, obviously legally there is no issue with control, right? You have the voting block of stock that can outvote the ESOP trust in any instance. But even in the 100% transactions, control is really not an issue, because we would seek to negotiate and get our sellers control of that board of directors for some time frame until they've got their money out of it, at which time that right will go away.
Gotcha.
So back to your sort of initial question, we could absolutely use an ESOP to buy out the founder and leave the kids with real stock. But I would encourage them to compare and contrast that to everyone exiting today through the 100% option, because we can get some equity back to the kids in another way. We typically carve 15% off the top, like a private equity firm would, and put it into an options plan for management. We use phantom stock in ESOPs, but it acts as almost like a stock options plan with a private equity firm. So we can have a plan where up to 15% is taken off the top, and very select few will participate in that, in addition to potentially getting ESOP stock. So we would want to run that analysis with those incentives alongside doing the partial transaction where the owner just exits and the kids continue to hold the equity. It depends on the business. If it's a high growth business, there could be a lot of value in them continuing to hold that equity, because by the time they're ready to sell, maybe the company has significantly grown in value. But if it's a low growth business, there are some negatives by doing the partial, in that we're going to create a new liability that doesn't exist by releasing this ESOP stock that has to be repurchased by the company at some point in time. Well, fast forward 5-10 years down the road, when the kids want to sell, we have to quantify that liability, and they're going to take part of the value hit for that. So they have to grow enough to offset the negatives of the partial transaction for the remaining shareholders.
Great.
So kind of complicated, but we do all that modeling for clients and try to, what we do is we don't say do this. We model all the options for them so that they can see the effects on each. Because those two transactions you mentioned, they share the word ESOP, but they couldn't be more different in terms of what they accomplish for the sellers. 100% versus partial.
Great. Great explanation, Mike. Every owner wants to know the answer to this question. Is there cash at closing in an ESOP transaction? Show me the money.
Show me the money. Absolutely. That will greatly vary, though, depending on the type of business, right, and the leverageability of that business. As we know, construction contractors are not going to be able to borrow as much as a heavy equipment manufacturing firm, someone who has a lot of collateral. But we are able to do cash flow lending, multiples of cash flow with each of these. It might be, 2 times EBITDA for a construction business, whereas for a manufacturer or distributor with a lot of collateral, it might be 3 times EBITDA. So the amount of cash at close will depend on that strength of that company's cash flow. It's collateral somewhat, although most of our loans are truly cash flow based loans, but collateral will come into play on determining how hefty that multiple will be. And then on top of that, the size of the company is very important. From a lending perspective, bigger companies have more staying power in downturns. That's their view. So they're going to be a little more aggressive on a $5 to $10 million EBITDA business than they are on a $2 million EBITDA business. So yes, there would be cash at close, but the percentage, if I was to give you some norms, I would say on a construction-related entity, and that is a very ESOPs are very popular for construction-related entities because it tends to be a very good avenue for an exit for them because there isn't an active buyer universe out there. Whereas a lot of other companies, the M&A markets are going to compete heavily with the ESOP. And construction, it's hard for the M&A markets to compete with the ESOP. But I would say probably somewhere in the 30 to 35% range down, probably more like 25 to 30% down for a construction contractor. And we probably can get that up to maybe 35 to 40% down for other types of businesses like manufacturers and distributors. And then the balance of the purchase price. So if we're going to sell more than we can finance, that's typically paid off with either balance sheet cash if they're in a position where they have excess cash that can be used, and or giving them notes, IOUs from the company, promise to pay them after the banks are paid off. They get paid second. So the banks are the senior debt, or what we call the first mortgage, so to speak, and the selling shareholders would take the junior piece, the junior debt, and or the second mortgage in the transaction. So they're going to get paid a much higher rate on that than we're paying the banks.
So since we're talking about construction firms, what about their existing relationships with banking, their lines of credit, and bonding, most especially? Do bonding companies like ESOPs, do they work well with ESOPs? What kind of considerations revolve around that?
General comment, bonding companies don't like change, but they're, on the construction side, sureties are becoming very accustomed to these deals because it, in my opinion, is or has become the leading exit for a construction-related entity. Because unless they're going to pass it to some internal managers in an internal sale, or the kids, which we see less and less common these days, the ESOP is really a great way to go for a construction-related entity. It's a phenomenal buyer in that it'll pay a multiple of cash flow and give it a very good fair market value, because a lot of these companies have good cash flow. They just don't have a lot of collateral and other things that buyers might like. So bonding companies are part of the process. We've never had a problem in getting them to approve a transaction. It's just we have to be a little more cognizant to not pay off the debt too quickly. The bonding company likes to see, they'll agree to some level of amortization on these notes, but it might stretch it out. Instead of my earlier comment saying we're going to pay it off in 5 to 7, it might take more like 7 to 10. We probably we always set the plan on a 10-year amortization so we can show the bonding company that the balance sheet will get healthy real quick again. And then a lot of times we put in the subordination agreements with the bonding company that annually, if the company had a lot of excess cash, they would go request prepayment against the debt beyond the approved schedule. So bonding companies are always part of the process. When it comes to banking and lines of credit, if we're doing the transaction with the incumbent bank, which happens frequently, then we would just need to restructure those facilities to place a new term loan, make sure that the covenants on the line of credit work, and they're going to need to be revised for what we just did. So we would have to kind of redo all that. But a lot of times, too, we're shopping the financing and bringing in a competitive process. So oftentimes they're changing banks, and that would mean refinancing out any existing line of credit and or debt with current banks.
Got it. Well, that's great to know that if you do a lot of public works with bonding, then an ESOP is absolutely viable. That's
it's viable. It's a process, but
yep. We talked about control earlier, and founders of construction companies especially are control freaks by nature. They want to give up control. We talked a little bit about not giving up control. Are there mechanisms that you put in place that assure that control? What does that look like? What form does that take?
This is all negotiable. Let me start with that. And there's no norm here. But generally speaking, the way that we would approach the corporate governance of the transaction structure post-closing is the trustee's going to get heavily involved in negotiating the size of the board and who's on the board. So let's say we go to a 3-person board of directors. We would negotiate pretty heavily that while the debt's outstanding, the junior notes to the sellers, that they have 2 of 3 seats, any one of their choosing, insiders. So say you have 2 sellers, they're those 2 seats. And then the 2 of them would have to identify and nominate a 3rd board member who's completely independent of the company. No family members, no employees, and no advisors they pay fees to or the company pays fees to. Anyone else is independent. So it could be someone they know at another company, maybe an industry person that can help, maybe a retired executive from a construction business that could help, professional board member, maybe a financial type, an accountant or a lawyer who's not their accountant or lawyer, whatever. They would make the nomination, and as long as the person was qualified and independent, the trustee would approve that person. The trustee votes for the board, but we're going to put some curbs in place to say, that's fine, you vote for the board, but as long as the debt's outstanding, they have a certain number of seats so they can protect their investment. This is no different, Mark, than if I went out into the marketplace and I had to source that junior debt from an outside party. They are for sure going to have board influence and board control, very likely, if they're putting that big of an investment up. So anything we do with ESOPs, we look to the real world. We look to the marketplace. And if it's happening in the marketplace, we can bring that to bear in negotiating with the trustee the price and terms and structure of that debt. And we believe that as part of that, the sellers need to have control for some period of time to protect their investment. It needs to go away eventually. They can't have perpetual control here.
Right.
But they should be able to have it long enough to protect their investment, because any financier coming in would.
Equal to control issues, I think, is the issue of disclosure. So many of these closely held firms, again, they're family held, they're family owned, and they're not used to disclosing anything about the company, earnings, profits, expenses, et cetera, to rank and file employees. And so when you have an ESOP and rank and file employees are in fact beneficiaries, there are concerns about how much do they know about the company? What is your requirement to disclose? So I think it's an important issue to discuss early on. Can you talk a little bit about what the requirement is in that regard?
Sure. The legal requirement is quite simple. The only thing you have to provide participants in the trust, which are the employee owners, is an annual statement. And the annual statement, that's all it tells them is, here's how many shares you have in your ESOP account that were allocated to your account. Here's what you're vested in versus not vested in, and here's your account balance. Anything other than that, there's no legal requirement. Now, that's the bare minimum. We also, on the complete other end of the bell curve, have companies who do complete open book management, which we don't recommend, by the way. Most of our clients are doing something in between, meaning if you do the bare minimum, then are you really building the culture and getting the productivity gains that we see when we do research on ESOP companies that exist? Probably not. Full open book management is a very high risk proposition, because if that information gets out, that could be highly sensitive, right? You wouldn't want that in the newspapers. You wouldn't want your vendors and competitors knowing, the financial health of the company necessarily and what owners were paid. We see most of our clients do the bare minimum plus a little bit, where they might put out performance targets, as an example, KPIs, key performance indicators, to drive people to meet forecasts, because if forecast is met, there could be additional management incentives being dropped down from that management plan I told you about. And also helping all the employee owners get on board with achieving goals so that the value of the ESOP stock increases annually. So they might share sales goals. They might share production metrics in a production company. Maybe in some industries, safety metrics could enhance profitability. So it's up to, the bottom line is it's up to the company and its executives and its board on what it wants to share versus not share, other than the legal requirement, which is the annual statement. So it's a farce when I hear people say, oh, the employees are going to know what I'm going to make. That's absolutely not true unless you tell them.
Right.
There's no legal requirement to provide that information. Oh, they're going to know what the company's total value is. That's absolutely false. The only person that knows that information, other than the key insiders of the company, is the ESOP trustee, and that is not shared with the participants.
That is my next question. How do you choose a trustee? This person is obviously very important on a lot of different fronts. How is a trustee selected?
Well, there are probably, in my estimate, maybe 15 qualified independent third-party trustees that do this for a living nationwide. And from that set, my personal opinion is about half of them are qualified. So we fish from that pool, and what we do when we get in and do some preliminary work for a company to get our arms around the size of the company, the type of business it is, and what type of transaction we envision for them, whether it's 100% or a partial, after we get in their head on all that, we make recommendations of a subset of the trustees that we recommend they interview. So we usually, on average, have a client interview 3. If they want to do more, they can certainly do more, but typically we give them 3 names, and we facilitate interviews with these trustees. Since they're all over the nation, typically they're over Zoom or Teams or something like that. And we give the client a list of questions that we recommend they ask, and anything they have above that they can ask as well. And we conduct about an hour or so interview over the phone or Zoom. And then if the interview goes well, we invite them to make a proposal to us on, telling us who their team members are going to be and what the cost of their whole team's going to be to do a transaction like the one we described to them, because we give them an overview of the business and the transaction ahead of the interviews. So once we get those proposals, we summarize them and talk to our client, and usually the client, it isn't just the seller. They usually will involve a manager or a high-level person or 2 to sit in and have kind of a committee approach to interviewing these trustees. We then ask them to make a selection, and they select one, and once they select one and they hire that trustee, then that trustee from that point on is fully independent, discretionary, and represents the ESOP trust.
So there's a whole world out there of professional trustees. That's all they do, and then you've got the benefit of their expertise, making sure that you stay compliant, follow the rules. So probably not good advice to have your brother-in-law come in and act as trustee.
Yeah, we would not do a transaction without an independent third-party expert trustee. If a client ever wants to use someone internal, while the regs don't prohibit it, it's not best practices. We wouldn't even involve ourselves in a transaction like that.
Got it. There's a long list of industries that you've worked in with ESOPs, but what types of businesses are optimal for an ESOP?
Well, let's start with industries that don't have strong M&A prospects, like construction-related contractors. These are phenomenal cash flow companies. Yeah, the cash flow can be a little lumpy, but overall, the strength of cash flow is very strong, but you don't have a lot of buyer universe there. It's very, very hard, in my opinion, to sell a construction-related entity to a third party. You have bonding, non-bonding issues. You have union, non-union issues. You have a prevalent thought in the industry that companies are worth book value, which is absolutely not true. It's a very low metric, almost like a liquidation type value for a company. An ESOP will come in and pay a multiple of cash flow, fair market value for that business. So I would say construction-related entities are phenomenal targets for ESOPs, but any other business that where the owner is concerned about legacy, wanting to keep the company independent, not wanting to sell it to a larger business that's going to consume it, and the company they built is going to essentially get absorbed and go away. Or they want to see the employees do well in anything they do, because the employees do extremely well here. They get something for nothing, at no cost to them, in lieu of nothing. They pay nothing for this ESOP stock. It's all paid for out of company profits and tax incentives going forward that they help create, but nothing comes out of their paychecks.
So it's an interesting point that you're hitting on. Certainly the tax advantages are spectacular. But I think the other component that's necessary is, and I call it culture, the culture of the entity, and an altruistic founder or owner that has long-standing employees that wants to enrich them. That sort of a culture certainly is positive for an ESOP.
It absolutely is, but I do need to tell you that if I look at the 200 or so deals that we've done, not everyone does these things for altruistic reasons. We truly do have some owners attracted to the tax savings personally and converting the company into a tax-exempt entity where they think they can use that to compete better, and that might attract them to do it. And then building the culture ends up becoming something that they get their head around later. So not everyone raises their hand and says, I'm altruistic, I want to do what's right by the employees. That's not every candidate we deal with for an ESOP. Some are strictly attracted to the tax savings and benefits.
It's nice to know that it works.
And it works for all.
Successful.
It works for all, but the transaction will be successful. What is a question going forward, though, is can you build an employee-owned culture? And I think the ones that have that legacy, altruistic mindset are going to be more successful in building the culture than those that just did the transaction for tax reasons.
That's a good distinction.
Yeah. Not to say that the company that did it for tax reasons isn't going to be successful. It's just, I think it's going to be harder for them to build the employee-owned culture if that's not their values.
You mentioned that ESOP is it's a very complicated transaction. It takes a while to get done. So exactly how long does it take from beginning to end? If I want to implement one of these, how long does it take to sell my interest?
Well, what we recommend for every prospect is we first like to do what we call a preliminary ESOP assessment. And we'll do this without charging the prospect. So if we ever got approached, I like to do that on my own dime because I want to see what I'm dealing with. Example, if the company's too small, I want to say, hey, look, it's too small. The fees aren't going to, be justified here. You're probably better off doing something else. Or if they're unprofitable, you can't carry debt if you don't have cash flow. So we want to look and do a preliminary assessment for them. And I also want to flesh out some really, really important issues up front. Number one, you got to be a patient seller to do an ESOP. This is not a sell, I get paid off within a year or less and I'm on the beach. This is a 5 to 10 year commitment after you do the deal. Well, an earnout that's fixed. See, earnout has a negative connotation in my world where the payouts could potentially be when you lock it in with an ESOP, that's going to get paid out.
Fixed.
It's just a matter of whether it's going to be paid out in 5 years, 6 years, or 10 years.
Got it.
Okay, it depends on the strength of the cash flow. And obviously, we talked about bonding might lend itself more towards less payments along the way. But I would say that for the vast majority, we are able to get those paid off in 10 years or less. So, I don't think that it's a longer payout than that, and the value is fixed. But, you do have to be the right kind of owner and patient seller to say, yeah, I'm willing to stick around for that time frame to see this through. We also want to make sure in that preliminary assessment that we're like-minded on value. If I value it with adjustments and add-backs, et cetera, because we do need to normalize the cash flow for owner's comp and perks and personal expenses and things we commonly see, because we're going to be asking the ESOP to pay a multiple of what the cash flow is going to be on the back end, not what it is necessarily now, right? It's going to be without all the owner stuff in it. We want to make sure that we're like-minded on value. If I think it's worth 10 and they think it's worth 20, we're never going to get there. So we want to flush that out front. And the other thing is the percentage of cash down. You know, if it's a $20 million deal and somebody wants, you know, on a construction business, $15 million in cash, it's never going to happen. So I try to flush out those elephant type issues up front. And if after doing the preliminary assessment, they're still interested, then we move to what I call phase one of the process. Then they hire us at that point to take what we've done in the preliminary, which I'm about 65-70% probable on. I do all the due diligence, I nail down the valuation, I do all the structuring and cash flow modeling and tax analysis and employee benefits modeling, where we project out what people will get through their ESOP accounts, how we plan to release stock, the management incentives, we value those. The debt amortization schedules is very comprehensive. What I like to say is that in phase one, we are the architect. Think about the owner, forget a company. Let's say he owns a piece of raw land and wants to build a building. When you want to build a building, the first thing you do is not run out and hire a general contractor. You hire an architect to spec that building out, get it to your liking, tell you the budget to build that building and the timeline it's going to take to complete. Once that work plan, timeline, budget, and specs are all signed off by the owner, they then decide, do we build the building or not? That's what we do here. Preliminary is preliminary. Phase one, we're the architects. If we move to phase two, we're now going to implement the transaction. We are going to sell the stock to the trust and all the negotiations and diligence therein, and we're going to raise the financing. And we're going to fund and close that transaction. So preliminary, phase one, phase two. Preliminary, couple weeks. Phase one, 30 days. Phase two, somewhere between 90 and 120 days, depending on, you know, the situation. 4 to 5 month process, soup to nuts, typically.
Okay. Do you ever go out to a contractor or other business, you look at their financials, and they just don't have the financials in place to make it work, but they might in a year or two? Do you provide advice that says, hey, you need to clean this up, this up, this up, this up, and let's talk again in a year or 2 years? I think you'd be a great candidate. Do you ever run into that sort of scenario?
Happens every week.
Okay.
Well, that's why another reason we like to do this preliminary analysis. It gives them a buoy. You know, is it enough or not enough? And we're able to integrate it with financial planners like yourself who are running their personal stuff to say, is 10 million enough? If not, then maybe we should wait until it's 15 or 20. So we like to do the preliminary because once we have the information and that built, we can say, is now a good time to move to phase one? If not, let's put it on a shelf. Let's revisit this in a year or two and see where we're at. So yes, all the time we are, that's why we like doing the preliminary. I don't want to jump in with 2 feet and get paid to do something unless we can get it over the goal line. We are paid to get deals done. So we weed out the ones that aren't right timing or right fit up front in that preliminary. And a lot of our preliminaries do go in what I call the bullpen, where we will revisit that with them maybe annually until they're ready.
Okay, that's great to know. We already talked about the trustee and how they're involved. After the transaction is closed, I assume that the structure of running the business becomes a little tighter than maybe a lot of closely held companies. We need to have board meetings on a regular basis, take minutes appropriately, et cetera, et cetera. So you're going to run the business perhaps at a different level from an operations perspective than you did prior to the transaction.
That's fair. That's fair. You're professionalizing the company a bit. It's not quite to the level of a public company, but it is certainly going to be more professional than perhaps it was going in. Although you'd be surprised, I've met a lot of privately held companies that, whether they've been preparing for sale or not, they're very well run today. But things like, what might be different is they might not be accustomed to having reviewed financial statements. Well, going forward, they're going to have reviewed financial statements at a minimum. So that could be a change, right? Because you know, the trustee's going to want that, and if we have a bank borrowing, they're going to demand it. So, you know, maybe they never carried any debt. They didn't have a reason to spend the money on that. But if people are thinking about this down the road, it'd be a good idea to start that now. Get used to it. Get your books cleaned up. The other thing, every owner's running things through the company, personal type expenses, discretionary expenses. We right-size the cash flow to say, no, a new owner's coming in, they're not going to do those things. So those become add-backs, and the owner has to stop doing that. They're going to have plenty of cash flow to take care of those things on their own now, vis-a-vis the transaction, but they can't run that stuff through the company anymore because they don't own the company anymore. So there will be some changes like that, having to have 3 or 4 board meetings a year, which, they're not like public company board meetings, but you do have to have your directors meet and talk about strategic things and financial things and set budgets and approve executive comp and things like that. So it is a little different. You're absolutely right. What I like to say is it's kind of professionalizing the company a bit. Probably should have been that way all along, honestly,
Right.
but it just forces them to have to get there.
Yeah, it's great. We were talking about contractors and what a fertile time it is for them. They get great valuations right now. But a question that I had that came to me is licensing. We talked about bonding and banking relationships continuing post-sale, but what about who holds the license, the contractor's license, if it's ESOP owned?
The company.
Okay.
Yeah, the company holds a license. I mean, there are certain industries, Mark, that example, we have a really hard time in a lot of states doing an ESOP on a CPA firm because, the licensing has to be with the individual. And so in a lot of states, you can't do an ESOP more than 50% because you have to have the licensed individuals owning the company, law firms, great example. But in a lot of other industries in construction, there is absolutely no issue in going to 100%. That licensing has never been an issue for us in those deals.
That's great. There are several ways to finance an ESOP transaction. You alluded to that a little bit earlier. And we talked about banking. What does financing look like in an ESOP? When you say financing, what is that? What form does that take?
Well, first thing to note is that the financing is with the company. No bank is going to loan to the ESOP. There's no cash flow collateral in the ESOP. There's nothing in it. So the loans all come to the company, and the company makes a separate loan to the ESOP. So the ESOP ends up having a payable to the company, and it's a receivable the company has from its ESOP. So that all future cash contributions the company makes to the ESOP are cashless because they come right back to pay back that internal loan. So we finance ESOP deals really broadly in 3 buckets. Company cash, if they have it. This would be excess cash. Think of cash accumulating in a C Corp. The only way to get it out is to pay a dividend and pay a tax on it. Well, if you accumulate all that tax in a C Corp, I can get all that tax out for them with no tax impact.
Retained earnings.
Because we're gonna defer all taxes on the sale permanently. So we're able to get the cash out without paying any tax on it that's accumulated in the C Corp. So company cash is one bucket. Bank borrowing is another, and those 2 represent the upfront cash. And then the plug figure between that down payment and the total value is the notes the sellers take back. And every majority ESOP we do, every 100% ESOP we do, we always have an element of notes there because we can't borrow 100% of the value of the company. So, think about it like this. If we're borrowing maybe 35% of the value, maybe they have another 10 in company cash that can be used. That's 45%. That means 55% is being funded in a note. Or more commonly, we're just doing a bank borrowing for 35 or 40%, and they're taking back a note for 60 to 65%.
An interesting question for last, and that's fees, because I think there is a widely thought that, oh boy, these transactions are expensive. So I thought, could you tell a little bit or talk a little bit about fee structures of ESOPs and what is being paid for exactly in that process from beginning to end? What is the client receiving for fees?
So when we quote fees, we don't just quote my fees or our firm's fees. We quote fees for the whole solution. Why? Because I can't do it all myself. As a general contractor of a project, think of construction again, the general can't do everything on their own. They need subs. We need subs in an ESOP too. So we'll have a fee to do the phase 1, that'll be fixed. We'll have a success fee to do phase 2 and place the financing and close the transaction. But we have to hire a lawyer on our side, the company side, to document everything and lead the diligence. And then we have to hire a trustee, and that trustee is going to have their own financial and legal person that have to be paid. So there are about 5 professionals that have to be paid in the budget I put together. Look, if we were selling a company to a third party, let's just approximate fees on that transaction between the investment banker and the lawyer at 2 to 4%, broadly. I mean, it's going to be 4 for a smaller company, maybe 2 to 5%. Maybe 4 or 5 for a small business is going to be closer to 2 to 3 for a larger business. The fees for the ESOP are the same, but they're going to be on the low end of the range. Most of the transactions we work on, total fees are in the range of 2 to 3%, most of them. Now, there are exceptions to that. A very small company could be 4 or 5, and a much larger company, you get into hundreds of millions of dollars, it could be 1.5% or 1%. So, broadly speaking, $10 to $50 million business, 2 to 3% in total fees.
Okay.
It covers
that's
everyone.
a great job.
Covers everyone.
Yeah, and puts it in comparison. You're right. If you're going to sell to an outside third party, you would broker that. You would pay those fees every day, all day, and be happy to do it, frankly.
Right.
So,
one other very important thing about fees, though, if we sell it to a third party, and let's say the fees are, let's say you sell a $20 million business in a third party transaction, the fees are $500,000. The owner's getting $19.5 because it comes out of their stack. Sell it to an ESOP for $20 million, and the fees are $500,000. Let's just keep that consistent. The owner's getting $20 million. The fees are paid by the corporation, and they don't affect what the owner takes. So yeah, we'll affect the amount of cash we can give the owner down by $500,000 because we had to use $500,000 to pay the fees, but they're still getting full value. They're still getting the full $20 million. It's because it's for the establishment of an employee benefit. We consider the fees to be a non-recurring expense. It doesn't affect the valuation. And the fees are tax deductible because it's for the establishment of an employee benefit. So we can deduct the fees too and get tax benefit for them. Whereas in the M&A side, they come out of the personal, the owners, there's no tax savings.
right. I mean, the IRS has sanctioned these. They like these transactions. They want these transactions to occur.
Yes.
So that's why the tax law is written the way it is. Wow, I've learned a lot about ESOPs, and I know there's a lot more, especially on the detail side, but I thought I'd give you an opportunity to add anything else that you'd like that we didn't talk about that you thought might be important for our audience to know, if anything.
I would, when you have a prospect or a business owner that wants to explore it or learn more about it, I highly, highly recommend doing that preliminary assessment with someone like us, where they don't have to pay a lot of fees or really with us anything to get that preliminary analysis done, because I think I would, as a business owner, want to know what this could look like, and does it check enough boxes for me before I jump in and start hiring a bunch of people to do work. So whoever the prospect is talking to, the industry calls it a feasibility study. I call it a preliminary ESOP assessment. It's a similar thing. I would say start with that, have that done. Some firms will charge for that. Our firm does not. Get that done, because you're going to learn a lot going through that process about what an ESOP is and isn't, what it can accomplish for you, if anything. And you want to know that before you jump in with 2 feet.
And the health of your company.
That's
and what
true.
things you can do to make it increase in value. I think those are amazing benefits out of the process.
Yeah, and if nothing more, the owner learns about this as an option, and they may be able to say, not for me. At least I learned about it, So I think nothing lost there other than just a little investment of time on the owner's part.
Clearly an expert in your field, and I thank you for your time today, Mike.
Thank you for having me, Mark. Appreciate it.
So that's it for this segment of the Prosperity Podcast. I hope you enjoyed our discussion with Michael Harden on ESOPs. Until next time, I'm Mark Chandick. Thank you for tuning in to the Prosperity Report. If you enjoyed the episode, I want to offer you a free download of my latest book, 10 Financial Strategies for the Smart Investor. It's a candid view of where we go wrong with money and how to get back on track. In it, you'll discover how to avoid common mistakes and build lasting wealth. To get your free copy, first click the subscribe button you see on your screen. Then find the link in the show description below and click on that. Soon you'll be on the way to turning all your possibilities into true reality.